Welcome to Innovating with Scott Amix. I'm your host, Scott, and today I'm joined by Sean Harper, who is the CEO and co-founder of Kin. Welcome, Sean.
Hey, thank you for having me.
All right, so you have an incredible background. You started out at the venture side, Longworth Venture Partners. Well, actually, you started on the BCG and then you went back to BCG. How did those experiences prepare you for your entrepreneurial journey and success?
BCG is consulting, and my co-founder Lucas was an Accenture consultant. We both have that in common in our experience. It's really good for being an entrepreneur, and the first reason is that you get to drop into all these big companies. And I think people have this idea a lot of the times that like big companies really know what they're doing, and you learn very quickly that that is not true, because you're this like 22-year-old guy and you get dropped into this place. And you actually look around and you're like, oh my gosh, like everything is broken here. And you talk to all the smartest people and they're like, oh yeah, this is broken and this is broken and this is broken. And amazingly, management consultants get paid to basically find all the broken things and like put them on a slide. And that's a big part of how they make their money. So it really is good for creating opportunities. And actually, like all three of my businesses, they were all started as a result of observations that I made during those 5 years that I was at BCG. So that's one way. And then the other one is it teaches you how to be really self-sufficient, because you're this like kid who doesn't know anything. And here you are, and you have to like go talk to the CEOs of these companies. Like you just need to figure it out. And there isn't a whole lot of support structure. I mean, a lot of the times it was just me and a couple of dudes in a conference room somewhere. And that's actually very similar in entrepreneurship, just creating something out of nothing. And so, the way things shook out for me was, I was a nerdy kid growing up. I liked to program computers, and that's sort of what got me into all this. Yet then when I was in school, I went to the University of Chicago, and I got really into economics and ended up doing all my internships at like investment banks and hedge funds. And that led me into BCG. And after like 3 years there, I was like, man, I thought I was a tech guy. What's going on here? I'm spending all my time making spreadsheets for banks and insurance companies. This isn't at all what I expected. And so then I went out to find a job, but I wasn't really actually useful as a programmer anymore, because I'd spent the last 3 years doing spreadsheets for banks. I was fortunate enough to find a VC gig, and the VC analyst or associate role is really cool because you get to meet with all these different companies to sort of see how they do them. It's really been helpful to me in understanding the way the venture capital industry is structured, like the way those deals work. It helped me meet a lot of really amazing entrepreneurs. Like, one guy that had a big influence on me was I sat right next to Brian Halligan, the founder of HubSpot, which is this big successful company, when it was just an idea, literally on a chalkboard. And actually, like his first idea wasn't that good, and he pivoted into what HubSpot became, and that was just very inspirational to me. And I've always really looked up to him. But the other really cool thing that I learned after being a management consultant, where you're working like 80 hours a week and you're traveling all over the place, associates at VC firms don't work as much. And so I went from working like 80 hours a week to working 50 hours a week. I was like, what do I do with all this time? And the girl I was seeing at the time was in law school, so she didn't have time to hang out with me. And so in my spare time, I actually started my first business. And that was a company called TSS Radio. It was an e-commerce company, physical products in the satellite radio space when that was growing really fast. And that was just an awesome experience because we started it out of nothing. I wrote every line of code in the whole business, and we bootstrapped it onto the Inc. 500 like 4 years later. It was like very improbable. We never really thought it would work, and it did. And after that, I was hooked. I was like, I love this. I don't want to go back to working for doing spreadsheets for banks anymore. So that was, and then from there, I've started 3 businesses since then. One was Fee Fighters, which worked out really well. I sold it. The next one was a rental car company that didn't work out very well. It never really got off the ground. And now this one is Kin Insurance, which so far is going well. Although just like everyone else, we've had plenty of ups and downs, which is part of what makes this fun.
So the biggest insight that I gained is if you want to start your business, work as an associate at a venture capital firm because you'll have plenty of time. But going back to what you said about BCG is that I think sometimes those that are in the industry too long are hesitant to ask basic questions. And I think what consulting does prepare the consultants well is never take anything to be assumed. Always ask the bare, basic fundamental question. And I know one of the things that University of Chicago is really well known for is instead of asking the how and the what, ask the why. Why are you even doing this in the first place? So it really helps you to be very inquisitive and go against the grain and ask for some of the fundamentals really oftentimes are overlooked. So
Yeah.
you mentioned Fee Fighters, and that was acquired by Groupon. How did that fit into their breadcrumb payments portfolio?
So at Fee Fighters, the basic technology that we built was we built a payment processing system. So it would intake the payment from the merchant, the credit card gets swiped or entered in, and it would sort of shuttle it off to Visa, MasterCard, Amex. And it also handled all of the underwriting and onboarding associated with signing that merchant up. Because as a payment processor, you actually have a lot of risk because if the transaction gets charged back, it's actually on you to if there's a fraudulent transaction or something. So you have to be very careful. And at the time, Groupon was this social phenomenon where people are using it to discover new places to go locally, like restaurants and spas and stuff like that. And it was very profitable because Groupon could basically take half of the transaction value. And one reason why that worked is because local merchants don't have a lot of other ways to get customers. They used to use the Yellow Pages and stuff. Now that's not a thing, so they had to use Groupon. And what Groupon was really looking for were two things. They wanted to get deeper into those merchant relationships to create stickiness. Because the problem with these daily deals was you could run one with Groupon, and then you could the very next month decide, I want to run with Living Social instead. And there wasn't any stickiness there. Payments, on the other hand, is extremely sticky. If you're in the merchant's point of sale, every transaction of the whole business is going after it. It's super hard to rip it out. People even will hate their payment provider. They're I hate that guy. He charges me too much money. It never works right. You're well, do you want to switch? You're no, that would be way too big of a pain in the butt. So they were looking for stickiness. And then the other thing that they were looking for was at the time, the way Groupons worked, there's this pre-mobile app. You actually printed out a piece of paper, a coupon, and you walked into the business and you handed them this coupon, and it didn't feel good, right? So no one wanted to do that. And what we were able to do is actually, because we were in the merchant's point of sale system, we could actually redeem that Groupon automatically by looking at the mobile device if it was in the store, or by following the credit card swipe. It had a lot of other really interesting ideas around the analytics of it, because once you followed that first swipe, then we could actually follow the repeat transactions that user did at that merchant. And part of the big debate at the time, Groupon thought that the customers they were sending to the merchant, that was becoming a good repeat customer for the merchant. And many of the merchants were no, man, they only come the one time and they don't come back. And so having the data around how much that actually happened was really important. So that's why they bought us. And we actually built a pretty big point of sale and payments business within Groupon. When I left a couple of years later, we were doing about $1 billion of transaction volume. It just it became hard to keep that going when Groupon ran into other sort of strategic problems.
Yeah. Well, this is fascinating because your work on the transaction, the analytics, which becomes super key, that has brought you to today, your current startup, Kin, which really focus on catastrophic prone markets, specifically homeowners insurance. So tell us about your startup, what it's focusing on, and why this now?
Yeah, so what Kin does is we're like a mini Allstate. We insure homes and other buildings, and we do that in the riskiest places. We do that in places where hurricanes hit, wildfires, flooding, and that's actually an increasingly large part of the country. As the weather gets worse, and as people actually are moving to these places, it's kind of funny. Like sometimes people ask, well, like, gosh, with global warming, are people moving out of Florida? Like, no, actually, people are moving away from Illinois, where I live, and they're moving to places like California and Florida. So this is a $50 billion market of catastrophe-exposed property insurance. And so what Kin does is, rather than doing it the old way, where there was a broker involved and the user had to like get a bunch of questions and stuff, and there was a manual underwriting process, we actually pull in automatically all the data about the home. It comes from there's a lot of weather data we use. There's a lot of data coming off of the real estate industry. We use a lot of image-derived data, so we can actually take like a satellite or aerial or street view image and pull data out of that about what the home is like. And then there's a lot of public records data that we use. And so we crunch all of that, and we're actually able to insure you in minutes. And we're also able to insure at a much lower, or often lower. It's not always lower. It's often lower, but it's always more accurate. Because one problem that the legacy insurance companies have, they have two really big problems. One is they're very inefficient. So of every $1,000 that you spend with your insurance company, like 700 of that goes to pay claims, which is what you as the customer care about. The other 30% goes to, like, I don't know, other stuff. It goes to a skyscraper with the insurance company's name on it. It goes to pay the broker. It goes to run their really old, crappy computer systems.
They do have great commercials.
It goes to the commercials, absolutely, yeah. It goes to all this stuff that you as the user probably don't care about. So that's one big problem. They're inefficient. The other problem is they don't have enough data to price some of these risks accurately. And as the world changes faster, being able to pull in new data sources to actually like figure out the right price for each risk is really, really important. It's something that we excel at, because at our core, we're actually in a tech company. And this is a trend that you see happening in financial services all over. Is if you look at the core of a bank or trading firm or insurance company, they're actually software companies. But at the same time, a lot of these companies were started like 100 years ago, and they're not very good at software, and they haven't adapted to the modern tech. So that's what we're doing at Kin. Our customers like us because we're usually cheaper, and we're always easier and have much better customer results. So a typical insurance company will have a net promoter score of between 30 and 40. Like 50 is considered good. That means half their customers like them and half of them don't. Ours are more like 90. So the vast majority of our customers are happy, and it all just comes because we're working from a superior tech platform.
So let's talk just real briefly about algorithm and how that algorithm and the weights that are assigned to the various variables that's used for underwriting purposes and the risk assessment. How does that differ based on region? So, for example, I know you guys are very much anchored in the Florida, and I believe you're a carrier there as well. But as you move on to other markets in the U.S., how do you tune that? And also, is there machine learning that automatically looks at the optimization of the coefficients, or is it really kind of preset and human-fed supervised?
It's a mix. So yes, there are some things that are the same between different places. There are some things that are really different. So even if you take like two states that were in Florida and California, the risks that you're insuring there are very different. The homes the way they're built are very different. The data sources that are available are different. The basic pricing algorithm is sort of the starting point of it is actuarial science. So that's not machine learning. That's actually like based upon historical results of insurance results and tweaked by a human. On top of the actuarial stuff, then you can actually add a machine learning layer, which can help you figure out a much more granular pricing than you can just using the old actuarial methods.
So let's talk about Florida as an example. So if you look at researchers and other institutions that's looking at climate change effects, such as Climate Central, where you can actually simulate the rise in sea level as an example, and how much of Central Florida is going to be potentially affected, if not submerged, and not just Florida. There's so many places around the world. Um, Talk to us about how you guys are looking for predictively, given the fact that actuarials, like you said, is more historical, and given the fact that the frequency and the intensity of the hurricanes and flooding and events are going to potentially increase more. How do you factor that into account, and when your kind of rear view mirror is telling you something slightly different?
Potentially. I think there's a big question mark. Actually, and there's a lot of different points of view on what rising sea levels and rising sea temperatures are going to do to hurricanes. I think the prevailing point of view is that there will be fewer hurricanes, but they will be stronger and they will move slower. And of course, that has implications. And you've seen some of these slow-moving hurricanes have dumped crazy amounts of rain, which has been a different experience. It used to be that most of the damage from a hurricane came from the wind. That's actually very addressable. You can easily build a home. It's a little bit more expensive. You can easily build a home that can withstand 200 mile per hour winds, which is really the fastest that a hurricane will ever go. But now you see that actually there's a lot of rain getting dropped, way more than there was in the past. So you have to change the way that you're building the home. And a really big part of what we do is we pull all this data in to figure out which homes are going to be more resilient to the weather. And it's a function of exactly where they are, because one block can actually be very different than the next block. Like 2 feet of elevation can make a huge difference. And then the other thing is the how the home is actually built. And so you can build, like there was Hurricane Michael went through the panhandle of Florida last year, or 2 years ago, and there was this New York Times article about this one home that was like right on the ocean, and it withstood everything. It was just built really, really well. So you can absolutely build your home to be resilient to flooding. You just build it a little bit higher. You put it on some blocks. And obviously in places like Florida, you don't have basements. So I don't buy at all this idea that like Florida and Texas and North Carolina are going to become uninhabitable. You're just going to have to build differently and build in slightly different places. Like there probably are places like on Barrier Islands of North Carolina. Like those islands are literally washing away.
I really like your point, because if you look at places like Holland and certain parts of Scandinavia and just kind of that upper region of Europe, they've kind of had to deal with ebbs and flows and rise in seawater, and have really actually acclimated. And that goes to the point of climate adaptation, really, is how you actually become more resilient to some of these things, rather than just simply saying, hey, we're going to give up and move.
And you have to. There's no alternative.
Oh, absolutely. Absolutely. There's just too much money and people involved there. So the question is a couple of things. One is, when other carriers are filing for bankruptcies, that includes utilities as well, like PG&E in California with the fires, and other carriers are basically saying, look, we are not willing to insure, or if we're going to insure, it's going to be prohibitive. When that is happening, how are you guys able to, aside from just operational efficiency and cost reduction, how are you guys able to insure something that most are saying is too risky as a class to insure? So that's one. The second thing is, to your point, is if in fact there is a damage, the reconstruction costs, that's going to potentially factor into account something that's more resistant or resilient to classification level 4, as an example, that's going to have a higher cost. So how do you kind of factor all that in?
Yeah, it's really about coming up with an accurate price based on accurate data. I think where insurance companies run into problems is where they can't give an accurate price. And where they're basically, they don't have enough data to tell between the risk that is worth X and the risk that's worth Y. So if you have to charge the same price for both of those, you're just going to lose money every year. If you can actually figure out the right price for those, it may be expensive. Then the user will have to pay more money. And we definitely have a lot of users that sign up and they don't ultimately insure with us. And that's because, given the granularity of our pricing model and our risk model, We say no. We think it's going to cost $5,000 to insure. And you know what? If you can go get that insurance for $4,000, go for it. We have a point of view on the risk. So insurance companies are going to need to get much better at pricing the risk granularly as the world gets riskier. And also as the competitive pressure gets harder, because the fact that we exist and we are pricing this risk granularly is going to exert a pressure of adverse selection on our legacy competitors that aren't able to do that. So that's really what it's all about. It's just the right price. Like, there is a price of risk for every house. You just have to figure out what it is. And then on the other side, in terms of rebuilding, our insurance policies, just like everybody else's, they pay to rebuild the home that you're in currently. So they do not pay to upgrade your home. So that's sort of a separate factor. And it's an interesting question. There could be an interesting new product there where you could actually insure for a little bit more, and you'd rebuild your home in a more disaster-friendly way. I will say one exception to that is that in areas where the building codes have changed, like they have in Florida, for example, most insurance policies will actually pay for you to rebuild your almost all insurance policies will pay for you to rebuild your home up to the current code. So in that case, you are sort of getting priced into your insurance policy the ability to upgrade it to be more resilient.
Yeah, that's a good point. So let's for the remainder of the time that we have, let's talk a little bit about, before you went into this homeowners insurance market, and of course now you're really deep and you become a deep subject matter expert. But as you kind of gone through that journey, what have you found that's been kind of surprising or something really interesting that you would have not known had you gone into this sector?
One thing that surprises a lot of people is the average age of our customers. So I'm 39, so I'm sort of like borderline millennial, and I was sure when I was starting this business that we would be mostly insuring younger people, digital natives. And a lot of people said, no, the older people, they want to do it the old way. They like their broker, like whatever. Actually, the average age of our customer is 54. Wow. And interestingly, when you go and you talk to people and you ask them in a polite way, you say, hey, you're kind of old. Like, why did you use us? They say, it's really, I mean, I feel like an idiot saying it now, but they're like, well, yeah, I have a Vanguard brokerage account. I bank online. Like, I'm not an alien, And so it turns out that's true. And if you look at the data, people in their 50s, 60s, 70s, they actually use a lot of financial services online. They're huge consumers of it. Like, try finding a 60-year-old that doesn't have a Vanguard brokerage account or a Fidelity trading account. Like, it's actually really hard, or a Capital One credit card. So it's not just that digital natives want to do stuff online. People of all ages do, and it's not because it's online. It's because it's efficient and because it's easy. It's a superior technology. So I thought that was really cool.
That's incredible, and certainly opens up the market from a TAM perspective. We only have time for one more question, which is, in your experience, what has been kind of the biggest product or just company failure, and what was a lesson learned that you can share?
I did try to start, between Fee Fighters and Kin, I tried to start a rental car company, and it was cool because it was basically like, the value prop was it was an Uber-like pickup and drop-off experience. So instead of having to get off of the plane and ride a train and go to a parking lot and get the car, that all takes a lot of time. It's inconvenient. We would actually zoom up and just give you the car. The users loved it. The regulators, the airports didn't like it quite so much because it wasn't allowed by the rules. But the thing that I found personally was I didn't like dealing with the physical thing. And all the parts of that business I liked were making the app and figuring out the marketing. And the thing I didn't like was taking care of these cars. In fact, we had our car one of our cars got set on fire by a homeless person in San Francisco. And I was like, oh my God, I don't want to do this. So, that was just a lesson for me. And it's one reason why I'm attracted to financial services is it is a purely virtual good. It's all happening on the computer. And, that plays to my strengths personally.
All right, so no physical objects in material science for you. So with
Yes.
that, I've been joined by Sean Harper, who is the CEO and co-founder of Kim. Thank you.
Thank you.